In 1345, the Peruzzi Bank of Florence collapsed. It had lent the equivalent of several times the annual revenue of the English crown to the King of England, who defaulted. The collapse of the Peruzzi and their rivals the Bardi took with it most of the sophisticated credit system that had financed a century of Italian prosperity and triggered an economic depression that preceded, and may have contributed to the conditions that allowed the Black Death to do its worst work. The history of banking is not a quiet history of prudent men in offices. It is a history of enormous ambition, spectacular failure, systemic crisis, and slow and tested reconstruction. Tonight, we trace it from the beginning. Because the story of banking is, in a deeper sense, the story of civilization itself, of the organizational technologies that allowed human societies to grow beyond the scale of the village, to finance the construction of cities and the prosecution of wars and the accumulation of the surpluses that eventually produce the material world we inhabit. Every cathedral in medieval Europe was financed by credit. Every trading empire was built on it. Every industrial revolution was funded by it. The bank is not a building or a company or an institution in the narrow sense. It is a solution to one of the oldest problems in human economic life: how to move value across time and space, and how to transform the idle savings of the cautious into the productive investments of the ambitious. The history of how that solution developed, failed, was reconstructed, failed again, and gradually, imperfectly, became the system we live with today, is one of the longest and most consequential stories in human history. But let us start somewhere closer, right here, in the world you live in, at this moment. Let us begin with a clear account of what a bank actually is, in functional terms, because the definition matters for everything that follows. A bank, at its most basic, is an institution that accepts deposits and makes loans. It takes money from people who have more than they currently need and lends it to people who need more than they currently have. In doing so, it performs what economists call maturity transformation. It accepts short-term liabilities, deposits that depositors can, in principle, withdraw at any time, and converts them into long-term assets, loans that will not be repaid for months or years or decades. This maturity transformation is the core of what banks do, and it is also the source of their inherent fragility. If everyone tried to withdraw their deposits at once, the bank could not honor all the claims, because the money it holds is not sitting in a vault waiting to be retrieved, but has been lent out to others who are not yet in a position to repay. This tension between the liquidity of deposits and the illiquidity of loans is the central structural fact of banking, and it has been present in every banking institution, from the grain warehouses of ancient Mesopotamia to the digital platforms of the 21st century. Every banking crisis in history can, in some sense, be traced back to this tension, and every institutional innovation in banking history, from the bill of exchange to the central bank to deposit insurance, can be understood as an attempt to manage or mitigate this tension, to make the credit system more stable without eliminating the maturity transformation that gives it its economic value. There are several concepts worth establishing precisely before we trace the history, because they will reappear throughout the story in different forms. The first is interest. Interest is the price of borrowing money over time, the compensation that lenders require for parting with their money temporarily and accepting the risk that the borrower may not repay. Interest rates vary with the perceived risk of the borrower, the duration of the loan, the availability of alternative uses for the lender's funds, and the general level of monetary conditions in the economy. The history of interest is ancient, and the attitudes toward it have varied enormously. Many religious traditions have condemned the charging of interest, particularly between members of the same community, as exploitative or immoral. The medieval Catholic Church prohibited usury, the charging of interest on loans, creating an environment in which the financing of economic activity required considerable institutional creativity to circumvent the prohibition while complying with its letter. The eventual accommodation of interest as a legitimate economic activity, driven partly by the practical impossibility of suppressing it and partly by the gradual elaboration of theological arguments that distinguished legitimate returns on productive investment from exploitative, lending to the desperate, was one of the conditions for the expansion of commercial banking in the early modern period. The second concept is collateral. Collateral is an asset pledged by a borrower as security for a loan, which the lender can seize if the borrower defaults. Collateral reduces the risk of lending by giving the lender a claim on something of value if the primary obligation fails. The availability of good collateral has historically been one of the primary determinants of access to credit. Those with valuable and easily seized assets, land, precious metals, traded goods, can borrow on better terms than those without, creating a persistent link between existing wealth and access to the credit that enables further wealth accumulation. The history of credit is partly the history of the expansion of what counts as acceptable collateral, from land and gold to bills of exchange to financial instruments of increasing abstraction and complexity. The third concept is the bill of exchange, which is worth explaining carefully because it was one of the most important financial innovations in history, one that allowed the medieval Italian banking system to finance trade across the whole of Europe without physically transporting gold and silver between cities. A bill of exchange was a written order from one party directing a second party to pay a specified sum to a third party at a specified time and place. A Florentine merchant who sold cloth in London could receive a bill of exchange rather than gold, which he could then use to purchase goods elsewhere, or which he could discount with a banking house, receiving immediate cash in exchange for a slightly reduced sum, with the banking house collecting the full amount when the bill fell due. The bill of exchange allowed commercial transactions to be settled through accounting entries rather than physical transfers of coin, dramatically reducing the costs and risks of long-distance trade and creating, in effect, a pan-European payment system centuries before anything resembling a modern banking infrastructure existed. The fourth concept is the central bank, which deserves introduction here because it appears relatively late in the story, but plays a crucial role in the transformation of banking from a series of private enterprises into a system, a network of institutions whose collective behavior determines the monetary conditions of an entire economy. A central bank is a bank for banks. An institution that holds the reserves of the commercial banking system, provides emergency liquidity to banks that are solvent but facing short-term funding pressures, manages the money supply and interest rates to achieve macroeconomic objectives, and often serves as the bank of the government as well. The development of the central bank was not a planned achievement. It was an emergent property of the banking system, an institutional form that arose because it solved problems that the banking system repeatedly encountered and could not solve through private means alone. But to understand where these concepts came from and why banking took the specific institutional forms it did in different times and places, we need to go back, much further back than the Italian merchants of the 14th century, back to the civilizations that first invented the basic functions of banking, thousands of years before anyone had thought of Florence or London or the concept of a banknote. The earliest evidence of banking-like activity comes from ancient Mesopotamia, the region between the Tigris and Euphrates rivers that is now Iraq, and the evidence is surprisingly rich. Clay tablets from Sumerian and later Babylonian civilization, dating back as far as 3,000 years before the Common Era, record loans of grain and silver, deposits accepted for safekeeping, and payments made on behalf of depositors to third parties. The temples of ancient Mesopotamia were the first great financial institutions, serving as depositories of surplus grain and precious metal. issuing loans to farmers between harvests, and maintaining the records of these transactions on clay tablets that have survived in remarkable numbers to the present day. The Code of Hammurabi, the law code of the Babylonian king who ruled in the 18th century before the Common Era, contains detailed provisions regulating the terms of commercial loans, fixing maximum interest rates for loans of grain and silver, specifying the conditions under which loans could be renegotiated, and establishing penalties for various forms of commercial fraud. The existence of this regulatory framework implies the existence of a substantial and sophisticated credit market, one active enough and consequential enough that the state felt it necessary to legislate its terms. Interest rates in ancient Mesopotamia were typically in the range of 20 to 33% annually for silver loans and 33% for grain loans, rates that reflect both the scarcity of capital and the genuine risks of agricultural lending in an environment of uncertain harvests and fragile political conditions. The temples that served as financial institutions in ancient Mesopotamia were doing something that would be recognizable to any modern banker. They were accepting deposits, making loans, and charging interest. What they were not doing, at least not in the earliest period, was creating money through their lending, in the sense that modern banks do. Their loans were of existing grain or silver, not of newly created claims. This distinction matters for understanding the history of banking, because the capacity for money creation through credit is not an original feature of banking, but an emergent one, developed over centuries of institutional evolution. Ancient Greece and Rome both had sophisticated credit systems, though neither developed institutions as elaborate as the Italian banks of the medieval period. The Greek trapezitai, money changers, who also accepted deposits and made loans, were active throughout the classical period, and the speeches of the Athenian courts contain detailed accounts of commercial credit transactions that would not be out of place in a modern business context. The Roman argentarii performed similar functions, and the Roman legal system developed an elaborate body of commercial law that addressed the rights and obligations of borrowers and lenders in considerable detail. The collapse of the Western Roman Empire disrupted these credit networks significantly, as the trade routes and political institutions that had sustained them fragmented. But they did not disappear entirely. The Church, with its pan-European network of monasteries and cathedral chapters, maintained some banking functions throughout the early medieval period, and the revival of long-distance trade in the 10th and 11th centuries created conditions for the emergence of the more sophisticated banking institutions of the high medieval period. The Italian city-states of the 12th and 13th centuries were the crucible of modern banking. The combination of extensive long-distance trade, the concentration of commercial wealth in a small number of powerful merchant families, the existence of a sophisticated legal tradition, and the intellectual ferment of a period that was also producing the first European universities created conditions uniquely favorable to financial innovation. The specific innovations of the Italian bankers, the bill of exchange, the letter of credit, the partnership structures that allowed the aggregation of capital, and the double-entry bookkeeping that made the management of complex financial relationships possible, were so fundamental and so durable that they still underlie the practice of banking today. The merchant banking families of Florence, Siena, and Lucca first extended their reach across Europe in the late 12th and early 13th centuries, following the trade routes of Italian merchants into France, England, the Low Countries, and beyond. They established branches or agencies in the major commercial centers, built networks of correspondents who could honor bills of exchange on their behalf, and gradually accumulated the financial relationships that allowed them to serve not just individual merchants, but the greatest institutional borrowers in Europe, the papacy and the monarchies of England and France. This was where the ambition outran the prudence, where the detail that is crucial for what comes next begins to take shape. The great Florentine banking houses of the 14th century, the Bardi, the Peruzzi, and the Acciaiuoli, had, by the 1330s, lent enormous sums to Edward III of England to finance his wars against France. The loans were secured, in theory, by the revenues of the English wool trade, which the Florentines controlled through their role as tax farmers and wool merchants. But the revenues were uncertain. The king's need for funds was pressing and persistent, and the Florentines, caught between the impossibility of refusing a powerful monarch and the growing impossibility of collecting what he owed, continued to extend credit long after any rational assessment of the risk would have counseled withdrawal. When Edward III defaulted in 1339, and again definitively in the 1340s, the losses were catastrophic. The Peruzzi Bank failed in 1343, the Bardi in 1346. The collapse reverberated through the Florentine economy and the broader European credit system, contributing to the economic disruption that preceded the arrival of the Black Death in 1347 and 1348. And this is where the pattern first becomes visible, the pattern that will repeat itself throughout the history of banking. The sovereign borrower who is too big to refuse, the debt that grows beyond the capacity to service, and the sudden, catastrophic recognition that the assets on the books are not worth what the books say they are. Florence recovered, as cities and financial systems generally do, though not before a prolonged period of economic distress. The second generation of great Florentine banking houses, of which the Medici are the most famous, was more cautious than the first, at least in its early decades. Cosimo de' Medici, who transformed the Medici Bank from a modest local operation into a pan-European financial institution in the first half of the 15th century, built his network on the principle of diversification, spreading risk across multiple branches and multiple types of business, rather than concentrating it in loans to a single powerful borrower. The Medici Bank was not simply a credit institution. It was a trading company, an investment vehicle, and a political organization. Its financial relationships with popes and princes serving the political ambitions of the Medici family as much as they served purely commercial objectives. The Medici innovations in banking technology were as important as their organizational innovations. The Medici branch network, spanning Florence, Rome, Venice, Milan, Geneva, Lyon, Bruges, and London, was held together by a system of bills of exchange and letters of credit that allowed funds to be transferred across the continent without physical movement of coin, and by a system of internal accounting that allowed the Florence head office to monitor the performance of each branch and to manage the overall risk of the network. The double-entry bookkeeping that the Medici and their contemporaries developed and refined, recording every transaction as both a debit and a credit in order to maintain the systematic consistency of the accounts, was the information technology of its day, making possible the management of financial relationships at a scale and complexity that would have been impossible with earlier accounting methods. But the Medici Bank, like the Bardi and the Peruzzi before it, ultimately collapsed under the weight of loans to sovereigns it could not afford to refuse. By the end of the 15th century, the Florence and Rome branches had made enormous loans to the English crown and to various Italian rulers, loans that were not being repaid, and the discipline of the early Medici had given way to a pattern that would have been familiar to the founders. Credit extended for political reasons, at terms that would never have been accepted from a purely commercial borrower, piling up on the books, while the Medici's ability to service their own depositors and correspondents eroded. The Medici Bank effectively ceased to function as a financial institution in the 1490s, around the same time that the Medici family was expelled from Florence by the forces that eventually brought Savonarola and his bonfire of the vanities. The bank and the political dynasty fell together, as they had always been connected. Let us bring together everything we have traced so far, because this is the point where the history begins to lock into something more than a sequence of episodes. The pattern that emerges from the first 1500 years of banking history is not a story of steady progress toward an eventual stable equilibrium, It is a story of a recurring dynamic, innovation that expands the reach and power of credit, followed by overextension, followed by crisis, followed by the gradual reconstruction of new institutions that are more robust than the ones that failed, until the next cycle of innovation and overextension begins. This detail is crucial for what comes next, the transition from the private merchant banks of the Italian Renaissance to the first recognizable central banks of the 17th century was not driven primarily by some abstract appreciation of the need for a different kind of institution. It was driven by the repeated failure of private banking to manage the relationship between sovereign debt and financial stability, and by the growing recognition that an institution with a different structure and a different relationship to the state might be needed to provide what private banks could not. The Amsterdam Wisselbank, founded in 1609, was the first institution that resembled a modern central bank in some important respects. It was established by the city of Amsterdam to provide a stable and reliable medium of payment for the enormous volume of trade that passed through the city, accepting deposits in a wide range of currencies and providing merchants with standardized accounts denominated in a consistent unit of value. The Wisselbank did not make loans in its early years, maintaining something closer to a 100% reserve against its deposits than any commercial bank would have considered, and this conservatism made it uniquely stable in an era when bank failures were common. Its deposits, bank money as they were called, traded at a premium over coin in the Amsterdam market, reflecting the confidence that merchants had in the bank's ability to honor its obligations. The Bank of England, founded in 1694 under circumstances we have already explored in an earlier evening together, was a different kind of institution from the Wisselbank, one that was from the beginning deeply entangled with the finances of the state and that was always doing something more complex than simply providing a safe repository for merchant deposits. It was creating money, as we have discussed, through its lending to the government and through the circulation of its notes, and it was managing the inherent tensions of this money-creating role in ways that the Wisselbank, with its conservative reserve policy, had never had to confront. The history of the Bank of England across the 18th and 19th centuries is in large part the history of an institution learning, through repeated crises and near misses, what it actually was and what functions it needed to perform to maintain the stability of the broader banking system. The financial crises of the 18th century, of which there were many, and some of which were severe, including the South Sea bubble of 1720 and the banking panics that accompanied the various European wars of the period, gradually pushed the Bank of England toward the role of lender of last resort, the institution that would provide emergency liquidity to the banking system in a crisis, rather than standing aside and allowing bank failures to cascade through the financial system. The theoretical basis for this role was provided most clearly by Walter Bagehot, the 19th century journalist and economist whose 1873 book Lombard Street remains one of the most insightful analyses of the banking system ever written. Bagehot's dictum that in a financial crisis, the central bank should lend freely at a penalty rate to solvent institutions against good collateral is still cited by central bankers today as the appropriate framework for crisis management. The 19th century was the era of the great expansion of commercial banking in Britain, the United States, and eventually across the world. The Industrial Revolution created demands for credit on a scale that no previous economic system had required, and the institutional forms of banking evolved rapidly in response. The joint stock bank, allowing the aggregation of capital for many shareholders, gradually replaced the private partnership as the dominant form of commercial bank. The national banking systems of the major economies became more integrated, as improved transport and communication reduced the barriers that had previously limited the geographic reach of individual banks, and the interbank market, through which banks lent reserves to each other on short-term terms, became the mechanism by which the banking system managed its collective liquidity. distributing the reserves created by the central bank across the institutions that needed them on any given day. This was also the era of the great banking crises of the 19th century, episodes that punctuated the long expansion with sudden and severe contractions. The British banking panic of 1825, the American panics of 1837, 1857, 1873, and 1893, the Barings crisis of 1890, all followed versions of the same pattern. A period of credit expansion and rising asset prices, followed by a trigger event that undermined confidence, followed by a contraction of credit and a scramble for liquidity that threatened to take down solvent institutions along with insolvent ones. Each crisis produced some institutional response, tighter regulation here, an extension of the lender of last resort function there, the gradual building of the framework that eventually, imperfectly, made the system more stable. The American experience of the 19th century deserves particular attention because it followed a distinctive path that reflected the deep suspicion of concentrated financial power that ran through American political culture. The United States had no central bank for most of the 19th century. Having allowed the charter of the Second Bank of the United States to lapse in 1836 after Andrew Jackson vetoed its renewal on the grounds that it represented an unconstitutional concentration of financial power. The result was a banking system of extraordinary fragmentation, thousands of small state-chartered banks operating without a central institution to provide liquidity in a crisis. And the recurrent panics of the 19th century reflected this fragility. The panic of 1907, in which a speculative attack on the banking system was only contained by the personal intervention of J.P. Morgan, who organized a private rescue operation from his personal library. Finally convinced enough of the political class that some form of central banking was necessary, the Federal Reserve Act of 1913 established the Federal Reserve System, a compromise between the desire for central banking and the suspicion of concentrated power, with 12 regional Federal Reserve banks, rather than a single national institution, and a governance structure that blended public and private elements. The 20th century brought both the greatest expansion of banking in history and its most severe systemic crisis, events that reshaped the institutional landscape of banking in ways that are still with us. The expansion of the 19th century had created banking systems of growing sophistication and reach, but the regulatory framework that governed them remained patchy and inconsistent. The boom of the 1920s, fueled partly by easy credit and the expansion of new forms of consumer finance and stock market leverage, produced a banking system that was, by the late 1920s, significantly overextended relative to the actual creditworthiness of the borrowers and assets on its books. The collapse that followed between 1929 and 1933 was, as we have discussed on an earlier evening, partly a failure of monetary policy and partly an inherent consequence of the credit cycle dynamics of a banking system operating without adequate stabilizers. What emerged from the Depression was a banking system more thoroughly regulated than any that had preceded it, and one that operated within a different kind of institutional framework with deposit insurance, comprehensive bank supervision, capital requirements, and a Federal Reserve that understood its lender of last resort responsibilities more clearly than its predecessors had. This framework supported a period of unusual stability in banking that lasted from the 1940s into the 1970s, a period sometimes called the Golden Age of Banking, when banks were boring in the best possible sense, earning steady returns within a regulated environment that limited competition and therefore limited both risk-taking and innovation. The unraveling of this framework through the deregulation and financial innovation of the 1980s and 1990s and the emergence of shadow banking we discussed in an earlier conversation set the stage for the global financial crisis of 2008, which was in its structural dynamics the most serious banking crisis since the Depression. And the response to that crisis like the responses to every major banking crisis before it, reshaped the institutional framework in ways that were intended to prevent a recurrence, while leaving in place the fundamental credit creation dynamics that produced the credit cycle in the first place. So, what does the history of banking, traced across 4,000 years and multiple civilizations, actually tell us? It tells us several things, some more comforting than others. The most important and perhaps least comfortable is the one we have already touched on. Banking crises are not accidents or policy failures that a well-designed system would eliminate. They are recurrent features of a system in which private credit creation is the mechanism of money, in which the maturity transformation that banks perform creates inherent fragility, and in which the procyclical dynamics of credit expansion and contraction amplify both the booms and the busts of the economic cycle. The history of banking is a history of crises interspersed with periods of stability. And the periods of stability, however long, have not eliminated the crises that eventually followed them. Understanding this does not tell you when the next crisis will come, but it does tell you that the financial system you live in is subject to dynamics that no regulatory framework has yet been able to fully neutralize, and that appropriate humility about the durability of any particular period of financial stability is warranted. The second thing the history tells us is that institutional innovation matters. The bill of exchange, the central bank, deposit insurance, capital requirements, and the other innovations that mark the history of banking were each genuine advances that made the system more stable, more efficient, or more equitable than it had been before. Even if none of them solved the fundamental problems permanently, the accumulated institutional wisdom of 4,000 years of banking history, embedded in the regulatory frameworks and central banking practices of the modern financial system, is not negligible, and the crises that have occurred within it have generally been less catastrophic than they would have been without it. This is cold comfort in the immediate aftermath of a crisis, but it is historically accurate and worth remembering. The third thing is that the relationship between banking and power, between financial institutions and the political entities that both enable and depend on them, has been a constant and a complicating factor throughout the history of banking. The Peruzzi and the Bardi were undone by their relationship with the English crown. The Medici were entangled with popes and princes in ways that ultimately proved fatal to their bank. The Bank of England was created to serve the financial needs of the English state and has been managing that relationship ever since. The American Federal Reserve was designed partly to prevent the kind of private concentration of financial power that J.P. Morgan had embodied, only to become itself an institution of enormous power. The history of banking is inseparable from the history of political economy, and the institutions that govern banking are always, in some sense, political institutions, reflecting the balance of interests and the distribution of power at the time they were created. What this means for the world you live in, practically and personally, begins with something the orientation paragraph of this conversation wants to be clear about. The history of banking is not primarily a guide to individual financial decisions. It does not tell you which bank to choose, or how to manage your mortgage, or when to be more or less cautious about credit. What it does tell you is the shape of the system you are living inside, the institutional context that shapes the options available to you, and the risks you face. Knowing that banking crises are recurrent and that they follow recognizable patterns does not tell you when the next one will come, but it does tell you that financial stability, however long it lasts, is a condition to be maintained and managed, rather than a permanent achievement to be taken for granted. And it tells you that the institutions designed to maintain that stability, the central bank, the deposit insurance system, the regulatory framework, are the product of hard-won historical experience and deserve to be taken seriously even when their costs seem more visible than their benefits. Understanding the history of banking also changes how you hear the recurring debates about financial regulation, about the appropriate balance between financial innovation and financial stability, between the dynamism that credit creation enables and the fragility it creates. These debates are not new. They were present in ancient Mesopotamia, in medieval Florence, in 19th century America, and in the post-2008 regulatory process. The specific instruments have changed, and the scale has grown from the clay tablets of Babylonian scribes to the digital systems that now process trillions of dollars of transactions every day. But the underlying tensions between the economic value of credit and the instability it creates, between the benefits of financial innovation and the risks it introduces, between the interests of creditors and debtors and the public institutions that manage their relationship, are as old as banking itself. There is a quiet human thread running underneath this entire history, worth pulling into the light before we let this rest. The history of banking is, in the end, a history of trust, of the willingness of one person to give their gold or grain or money to another person they may not know in exchange for a promise that it will be returned with something extra, of the willingness of merchants separated by hundreds of miles to honor bills of exchange they had never seen their issuers sign, of the willingness of depositors to accept a number on a piece of paper and later a number on a screen in exchange for the physical gold or silver that the number was supposed to represent. Every innovation in the history of banking extended the reach of this trust, and every crisis in the history of banking was a moment when that trust broke down, when the promises that the system was built on proved, in some cases, to have been made in bad faith, and in other cases, to have been made in good faith by people who simply could not keep them. The system that emerged from 4,000 years of this history is imperfect, fragile, periodically destructive, and also one of the most remarkable organizational achievements in human history. It has allowed the concentration and direction of resources on a scale that no other economic system has matched, and it has sustained the economic activity that has produced most of the material progress of the past several centuries. It has also produced crises of great severity, distributed its benefits very unevenly, and remained, throughout its history, subject to the same human frailties, the same overconfidence, the same short-sightedness, the same susceptibility to the dynamics of boom and bust. That produced its first failures 4,000 years ago. You are lying there now in the dark, and the banking system is running, quietly, as it always has, connecting the savings of the cautious to the ambitions of the productive, creating money through credit and extinguishing it through repayment, managing the maturity transformation that makes modern economic life possible, and carrying within it the same inherent fragility that the Mesopotamian temple treasurers were managing 3,000 years before the Medici were born. The history of banking is long, and it is not finished. The next chapter is being written right now, in the decisions of central bankers and regulators and financial innovators, and the billions of ordinary people who borrow and save and spend, and whose collective behavior shapes the credit dynamics that determine whether the next cycle ends in stability or in crisis. You are part of that history, as everyone who lives in a credit-based monetary economy is part of it, whether they know it or not. What you carry now is the knowledge that you are part of it, and some sense of the shape of the thing you are inside, and that is perhaps the most honest place to rest. The Italian city-states of the 12th and 13th centuries were the crucible of modern banking. The combination of extensive long-distance trade, the concentration of commercial wealth in a small number of powerful merchant families, the existence of a sophisticated legal tradition, and the intellectual ferment of a period that was also producing the first European universities, created conditions uniquely favorable to financial innovation. The specific innovations of the Italian bankers, the bill of exchange, the letter of credit, the partnership structures that allowed the aggregation of capital, and the double entry bookkeeping that made the management of complex financial relationships possible, were so fundamental and so durable that they still underlie the practice of banking today. The merchant banking families of Florence, Siena, and Lucca first extended their reach across Europe in the late 12th and early 13th centuries. Following the trade routes of Italian merchants into France, England, the Low Countries, and beyond, they established branches or agencies in the major commercial centers, built networks of correspondents who could honor bills of exchange on their behalf, and gradually accumulated the financial relationships that allowed them to serve not just individual merchants, but the greatest institutional borrowers in Europe, the papacy and the monarchies of England and France. This was where the ambition began to outrun the prudence. The great Florentine banking houses of the 14th century, the Bardi, the Peruzzi, and the Acciaioli, had by the 1330s lent enormous sums to Edward III of England to finance his wars against France. The loans were secured, in theory, by the revenues of the English wool trade, which the Florentines controlled through their role as tax farmers and wool merchants. But the revenues were uncertain. The king's need for funds was pressing and persistent, and the Florentines, caught between the impossibility of refusing a powerful monarch and the growing impossibility of collecting what he owed, continued to extend credit long after any rational assessment of the risk would have counseled withdrawal. When Edward III defaulted in 1339 and again definitively in the 1340s, the losses were catastrophic. The Peruzzi Bank failed in 1343, the Bardi in 1346. The collapse reverberated through the Florentine economy and the broader European credit system, contributing to the economic disruption that preceded the arrival of the Black Death in 1347 and 1348. And this is where the pattern first becomes visible, the pattern that will repeat itself throughout the history of banking. The sovereign borrower who is too big to refuse, the debt that grows beyond the capacity to service, and the sudden catastrophic recognition that the assets on the books are not worth what the books say they are. This pattern, documented in the 14th century collapse of the Florentine banks, will reappear in the crises of the 19th century, in the banking failures of the 1930s, and in the global financial crisis of 2008. The specific instruments change, the scale grows, but the underlying dynamics remain remarkably constant across 7 centuries of banking history. Florence recovered, as cities and financial systems generally do, though not before a prolonged period of economic distress. The second generation of great Florentine banking houses, of which the Medici are the most famous, was more cautious than the first, at least in its early decades. Cosimo de' Medici, who transformed the Medici Bank from a modest local operation into a pan-European financial institution, in the first half of the 15th century, built his network on the principle of diversification, spreading risk across multiple branches and multiple types of business rather than concentrating it in loans to a single powerful borrower. The Medici Bank was not simply a credit institution. It was a trading company, an investment vehicle, and a political organization. Its financial relationships with popes and princes serving the political ambitions of the Medici family as much as they served purely commercial objectives. The Medici innovations in banking technology were as important as their organizational innovations. The Medici branch network, spanning Florence, Rome, Venice, Milan, Geneva, Lyon, Bruges, and London, was held together by a system of bills of exchange and letters of credit that allowed funds to be transferred across the continent without physical movement of coin, and by a system of internal accounting that allowed the Florence head office to monitor the performance of each branch and to manage the overall risk of the network. The double-entry bookkeeping that the Medici and their contemporaries developed and refined, recording every transaction as both a debit and a credit in order to maintain the systematic consistency of the accounts, was the information technology of its day, making possible the management of financial relationships at a scale and complexity that would have been impossible with earlier accounting methods. But the Medici Bank, like the Bardi and the Peruzzi before it, ultimately foundered under the weight of loans to sovereigns it could not afford to refuse. By the end of the 15th century, the Florence and Rome branches had made enormous loans to the English crown and to various Italian rulers, loans that were not being repaid. And the discipline of the early Medici had given way to a pattern of politically motivated lending that no private institution can long survive. The Medici Bank effectively ceased to function as a financial institution in the 1490s, around the same time that the Medici family was expelled from Florence. The bank and the political dynasty fell together, as they had always been connected. The Amsterdam Wisselbank, founded in 1609, was the first institution that resembled a modern central bank in some important respects. It was established by the city of Amsterdam to provide a stable and reliable medium of payment for the enormous volume of trade that passed through the city, accepting deposits in a wide range of currencies and providing merchants with standardized accounts denominated in a consistent unit of value. The Wisselbank did not make commercial loans in its early years, maintaining something closer to a full reserve against its deposits than any commercial bank would have considered, and this conservatism made it uniquely stable in an era when bank failures were common. Its deposits, called bank money, traded at a premium over coin in the Amsterdam market, reflecting the confidence that merchants had in the bank's ability to honor its obligations. The Wisselbank was, in this sense, the first institution that successfully separated the store of value and medium of exchange functions of money from the credit creation function, providing a reliable monetary foundation without the instability that credit creation introduced. The Bank of England, founded in 1694, was a different kind of institution from the Wisselbank, one that was from the beginning deeply entangled with the finances of the state and that was always doing something more complex than simply providing a safe repository for merchant deposits. As we explored on an earlier evening, it was creating money through its lending to the government and through the circulation of its notes, and it was managing the inherent tensions of this money-creating role in ways that the Wisselbank had never had to confront. The history of the Bank of England across the 18th and 19th centuries is, in large part, the history of an institution learning, through repeated crises and near misses, what it actually was and what functions it needed to perform to maintain the stability of the broader banking system. The financial crises of the 18th century, of which there were many and some of which were severe, including the South Sea Bubble of 1720 and the banking panics that accompanied the various European wars of the period, gradually pushed the Bank of England toward the role of lender of last resort. The theoretical basis for this role was provided most clearly by Walter Bagehot, the 19th century journalist and economist, whose 1873 book Lombard Street remains one of the most insightful analyses of the banking system ever written. Bagehot's dictum, that in a financial crisis, the central bank should lend freely at a penalty rate to solvent institutions against good collateral, is still cited by central bankers today as the appropriate framework for crisis management. What is remarkable is that this principle, obvious in retrospect, took roughly 2 centuries of banking crises to articulate clearly and another century to embed reliably in institutional practice. The 19th century was the era of the great expansion of commercial banking in Britain, the United States, and eventually across the world. The Industrial Revolution created demands for credit on a scale that no previous economic system had required, and the institutional forms of banking evolved rapidly in response. The joint stock bank, allowing the aggregation of capital from many shareholders, gradually replaced the private partnership as the dominant form of commercial bank. The national banking systems of the major economies became more integrated, as improved transport and communication reduced the barriers that had previously limited the geographic reach of individual banks. and the banking panics that punctuated the long expansion in Britain in 1825 and 1866, in the United States in 1837, 1857, 1873, 1893, and 1907. Each followed versions of the same pattern, and each produced some institutional response that moved the system incrementally toward the more robust framework of the 20th century. The American experience of the 19th century deserves particular attention because it followed a distinctive path shaped by the deep suspicion of concentrated financial power that ran through American political culture. The United States had no central bank for most of the 19th century. Having allowed the charter of the Second Bank of the United States to lapse in 1836, after Andrew Jackson vetoed its renewal, the result was a banking system of extraordinary fragmentation. Thousands of small state-chartered banks operating without a central institution to provide liquidity in a crisis. The Panic of 1907, in which a speculative attack on the banking system was only contained by the personal intervention of J.P. Morgan, who organized a private rescue operation from his Manhattan library, finally convinced enough of the political class that some form of central banking was necessary. The Federal Reserve Act of 1913 established the Federal Reserve System, a compromise between the desire for central banking and the suspicion of concentrated power, with 12 regional Federal Reserve banks rather than a single national institution. The 20th century brought both the greatest expansion of banking in history and its most severe systemic crisis. The boom of the 1920s produced a banking system that was, by the late 1920s, significantly overextended relative to the actual creditworthiness of the borrowers and assets on its books. The collapse that followed between 1929 and 1933 was partly a failure of monetary policy and partly an inherent consequence of the credit cycle dynamics of a banking system. Operating without adequate stabilizers, what emerged from the Depression was a banking system more thoroughly regulated than any that had preceded it, and the institutional framework that supported a period of unusual stability in banking that lasted from the 1940s into the 1970s. The unraveling of this framework through the deregulation and financial innovation of the 1980s and 1990s set the stage for the global financial crisis of 2008, which was, in its structural dynamics, the most serious banking crisis since the Depression. Let us bring together everything we have traced so far, because this is the point where the history begins to lock into something more than a sequence of episodes, and where we can begin to draw the threads together into what this history actually tells us about the system we inhabit. The pattern that emerges from 4,000 years of banking history is not a story of steady progress toward an eventual stable equilibrium. It is a story of a recurring dynamic, innovation that expands the reach and power of credit, followed by overextension, followed by the gradual reconstruction of new institutions that are more robust than the ones that failed, until the next cycle of innovation and overextension begins. This pattern is not accidental. It is a structural feature of a system in which private credit creation is the mechanism of money, in which the maturity transformation that banks perform creates inherent fragility, and in which the incentives of individual institutions systematically push toward risk-taking during periods of prosperity and risk aversion during periods of distress. The most important thing the history tells us, and perhaps the least comfortable, is that banking crises are not aberrations. They are recurrent features of a credit-based monetary system, as predictable in their structural dynamics as they are unpredictable in their specific timing. The periods of financial stability that banking history celebrates, the golden ages of banking that each generation is inclined to believe will be permanent, have never been permanent. And the institutional innovations that produced each period of relative stability, the central bank, deposit insurance, capital requirements, were not solutions to the problem of banking instability, but modifications to the environment in which it plays out, reducing the severity of the inevitable crises without eliminating the dynamics that produce them. What almost nobody mentions in the popular accounts of banking history is that the innovations that made banking more stable also made it more powerful, extending its reach into more domains of economic life and increasing the degree to which the economic fortunes of ordinary people were tied to the decisions of financial institutions they did not choose and could not meaningfully influence. The depositor insurance that prevents bank runs also guarantees that depositors have no incentive to monitor the risk-taking of their banks, since their deposits are protected regardless of how badly the bank manages its affairs. The lender of last resort function that prevents liquidity crises from becoming solvency crises also reduces the cost of risk-taking for banks, since they know that, in extremis, the central bank will provide the liquidity they need. These are not arguments against deposit insurance or the lender of last resort. They are arguments for understanding the full consequences of the institutional choices we have made, and for remaining alert to the ways that the solutions to banking problems create the conditions for the next generation of problems. There is genuine debate among economists and historians about several aspects of the banking history we have traced tonight. One significant debate concerns the relationship between financial development and economic growth. Does the expansion of banking and credit precede and enable economic growth, or does it follow from growth that is driven by other factors? And does the relationship vary at different stages of development and in different institutional environments? Another debate concerns the appropriate regulatory framework for a modern banking system. How much capital should banks hold? How should the shadow banking system be regulated? What is the right balance between financial stability and financial dynamism? And a third debate, more fundamental than the others, concerns whether the credit creation function of private banking should remain in private hands at all, or whether some version of public banking, in which the money creation function is performed by the state rather than by private institutions, would produce better outcomes for both stability and equity. These debates are not resolvable tonight, and honest engagement with them requires acknowledging that thoughtful people with access to the same evidence reach different conclusions, shaped partly by different assessments of the empirical evidence and partly by different underlying values about the appropriate role of private versus public institutions in economic life. What the history can provide is the context within which these debates make sense, the accumulated experience of what has been tried and what has resulted, which does not determine the right answers, but does constrain the range of answers that are historically informed rather than historically naive. What this changes for us, in the end, is something a little quieter than a policy position or an investment strategy. It changes our relationship to the financial institutions we live within. A bank is not simply a place to store money or a source of loans. It is an institution with a 4,000-year history, embodying accumulated solutions to problems that took centuries to identify and longer to address. It is also an institution with a 4,000-year history of periodic failure, of overextension and crisis and reconstruction, of the tension between private profit and public stability that has never been fully resolved. Knowing this, you can engage with the banking system with both appropriate appreciation and appropriate skepticism. Appreciation for the organizational achievements it represents and the economic functions it performs, and skepticism about the claims of any particular period of financial stability to be different from the ones that preceded it. There is a quiet, human thread running underneath this entire history, worth pulling into the light before we let this rest. The history of banking is, in the end, a history of trust and of the institutions that human beings have built to make trust between strangers possible at scale. The Mesopotamian scribe who recorded a grain loan on a clay tablet was performing the same essential act as the banker who enters a mortgage into a digital ledger today, creating a record of a promise, a formal acknowledgement of an obligation, a structure that makes it possible for one person to rely on another across time and distance. The bill of exchange, the letter of credit, the banknote, the deposit account, all of these are technologies of trust, ways of making the promises of strangers reliable enough to support economic activity on a scale that purely personal trust could never sustain. The fragility of this trust, its periodic collapse into crisis, and its slow, painful reconstruction is the darker thread in the same story. Every banking crisis is a crisis of trust, a moment when the promises that the system is built on prove insufficient, when the gap between what banks have promised and what they can actually deliver becomes visible and forces a reckoning. The 4,000-year history of these crises is a history of human beings repeatedly discovering the limits of the trust structures they have built and then rebuilding them, usually with some modifications that address the specific failure just experienced in preparation for the next round of expansion and the next crisis that the expansion will eventually produce. You are lying there now, in the dark. Somewhere, a bank is processing transactions. Somewhere, a depositor is sleeping without thinking about whether their deposits are safe, protected by an institutional framework built on the painful lessons of centuries of banking history. Somewhere, a central bank is managing its balance sheet, making the decisions that will shape the credit conditions of the economy for the months and years ahead. And somewhere, in the documents and records and databases of the financial system, the accumulated promises of millions of past transactions are being maintained. The web of obligations that makes the modern economy function continuing to hold as it has held for 4,000 years against the recurring forces that have periodically threatened to unravel it. The system is old, and it is not perfect, and it will fail again in ways and at a time that no one can predict with confidence. But it has also, between its failures, sustained the economic activity that has made the modern world possible. And understanding it, even imperfectly, even approximately, is better than not understanding it. Better than accepting the simplified stories that strip out the history and the complexity and leave you with a picture that does not quite match what you observe. You have a more honest picture now. And here, in the quiet of the night, that is enough to rest on. But we should return to a thread we moved through too quickly earlier, because it matters enormously for understanding the full sweep of banking history and for grasping why the institutional innovations we have traced were necessary. The thread is the relationship between banking and the state, the way that governments have depended on banks throughout history, and the way that banks have depended on governments, a mutual dependency that has shaped both institutions across 4,000 years, and that continues to shape them today. The dependence of states on banks is most visible in the history of war finance. For most of recorded history, the ability of a state to wage war was limited not by the willingness of its soldiers, but by its ability to pay them, and the ability to pay them depended on either accumulated treasure or access to credit. The great military powers of the ancient and medieval world were invariably those that had developed the most sophisticated credit relationships, able to mobilize resources beyond what their current revenues could support by borrowing against the expectation of future tax receipts. The Italian banking families who lent to English and French kings in the 14th century were not primarily motivated by political sympathy for either side. They were motivated by the interest income and the trade privileges that came with being the preferred financiers of powerful monarchs, and they accepted the risk because the returns, when the loans were honored, were substantial. When the loans were not honored, as the story of Edward III and the Florentine banks illustrates, the consequences for the lenders were catastrophic. The relationship between the Bank of England and the English state is the clearest modern illustration of how this dependency shapes institutional development. The bank was created to serve the state's financial needs, providing credit for the War of the Grand Alliance in 1694. In the century that followed, it continued to serve as the state's primary banker, managing the public debt, providing emergency credit in wartime, and gradually developing the additional functions of money management and financial stability that we associate with central banking. The bank's monopoly on note issue, its role as the banker to other banks, and its function as the lender of last resort, all emerged partly from the practical needs of the state and partly from the bank's own recognition of the systemic importance of the functions it was performing. This history has a direct and important implication for how we think about the independence of central banks today. The doctrine of central bank independence, the idea that the central bank should be insulated from day-to-day political pressure and should pursue its monetary policy objectives, primarily price stability, without being subject to government direction, is a relatively recent development in the history of central banking. Most central banks were closely integrated with their governments for most of their history, and the case for their independence rests on the empirical finding that central banks, subject to political pressure, have, in many cases, been used to finance government spending in ways that produced inflation, sometimes severe inflation. The independence doctrine is not a logical necessity. It is an institutional response to a specific historical pattern, and its application varies across different political and economic contexts. Understanding this context helps make sense of the debates about central bank independence that arise periodically in public discussion. When politicians argue that the central bank should be more responsive to the economic needs of the moment, they are making an argument that has substantial historical precedent and that sometimes has merit. When central bankers insist on their independence and their singular focus on price stability, they are drawing on a history of political interference in monetary policy that has, in several notable instances, produced inflation that was both severe and difficult to reverse. Both sides of this debate are drawing on real history and understanding that history is a precondition for evaluating the arguments honestly, rather than simply accepting the institutional arrangements of the present as natural or inevitable. There is another dimension of banking history worth addressing that often receives less attention than the dramatic stories of crises and collapses: the extension of banking services to populations that had previously been excluded from the formal financial system. For most of banking history, banks served merchants, governments, and wealthy individuals. The ordinary working person had no bank account, no access to formal credit, and no mechanism for storing savings more secure than a mattress or a clay pot. The extension of banking services to the broader population through the savings banks and building societies of the 19th century, through the deposit-taking banks that gradually expanded their retail operations in the 20th century, and through the mobile and digital banking platforms of the 21st, has been one of the most significant social changes in the history of finance, and it is a change whose full consequences are still being worked out. The savings bank movement, which began in Scotland and England in the early 19th century and spread rapidly across Europe and North America, was explicitly oriented toward extending the benefits of the financial system to working-class savers who had previously been excluded. The savings banks offered safe repositories for small deposits, paying modest interest, in an environment where the commercial banks were focused on mercantile and industrial lending rather than retail customers. The building societies and cooperative banks that emerged alongside them offered credit on reasonable terms to people who would previously have had no access to formal credit at all, or would have been forced to rely on informal lenders charging rates that reflected the absence of competition. These institutions were not purely commercial enterprises. They were, in many cases, explicitly social enterprises, aimed at promoting thrift and self-improvement among populations whose economic vulnerability made them susceptible to exactly the kinds of financial exploitation that predatory lending has always provided. The extension of financial inclusion in the 20th century was less straightforwardly benevolent, reflecting the commercial interests of banks expanding their retail customer bases, as well as genuine social objectives. The consumer credit revolution of the post-war period, which gave ordinary households access to installment credit, credit cards, and eventually mortgage finance on a scale previously unavailable, expanded economic opportunity in genuine ways, while also creating new vulnerabilities, new forms of over-indebtedness and financial fragility that affected the same populations that the credit had been intended to help. The subprime mortgage lending that contributed to the 2008 crisis was, in part, a degenerate form of financial inclusion. The extension of credit to populations that had previously been excluded from mortgage finance, at terms that many of them could not, in retrospect, sustain, driven by a combination of genuine social motivation and commercial incentive, and regulatory failure, that produced an outcome that served none of the stated objectives. This is the complexity that banking history consistently reveals, that the institutional innovations intended to solve one problem regularly create the conditions for the next. The extension of financial services to previously excluded populations is genuinely good for those populations when it is done responsibly and at sustainable terms. It is genuinely harmful when it is done irresponsibly and at terms that exploit the financial vulnerability of people who lack the resources or the sophistication to protect themselves. And the line between the two is not always clear in advance, which is part of why banking regulation has always lagged behind banking practice, addressing the harms of yesterday's innovation, while the next round of innovation moves into spaces that the existing regulation has not yet reached. What all of this points to, in the end, is something about the nature of institutions and why they matter. The banking system you live inside is not simply a set of buildings and computers and legal contracts. It is an accumulated set of solutions to problems that people encountered over 4,000 years of trying to organize economic activity at scale, to move value across time and space, and to make the promises of strangers reliable enough to serve as the foundation of economic life. The solutions are imperfect, and the problems they address have never been fully solved. But the solutions are also genuine achievements, and the framework they provide, the legal structure that enforces debt contracts, the regulatory system that constrains the worst excesses of credit creation, the central bank that provides emergency liquidity in a crisis, the deposit insurance that prevents bank runs, is the product of hard experience and deserves the kind of respect that is due to things that work, imperfectly, but substantially most of the time. You are lying there now, in the dark, at the end of a long journey through 4,000 years of banking history. From the clay tablets of Mesopotamia to the algorithms of modern digital banking, from the benches of the Florentine money changers to the glass towers of the modern financial district, from the invention of the bill of exchange to the invention of the credit default swap. The specific instruments have changed beyond recognition. The organizational scale has grown from a single branch in a city square to institutions with tens of thousands of employees and balance sheets larger than the gross domestic products of most countries. The speed of transactions has gone from days and weeks to milliseconds, but the underlying function has remained the same: accepting deposits, making loans, and managing the tension between the liquidity of the one and the illiquidity of the other. The promise that makes a bank has been the same promise for 4,000 years. Your money is safe here, and we will return it when you ask for it. That promise has been broken repeatedly throughout history, and the institutions that have grown up around banking are largely attempts to make the promise more credible, to reduce the circumstances under which it will be broken, and to limit the damage when it is. The attempts have had partial success, which is all that human institutional design ever achieves. What you carry now Resting here is a sense of the depth of that history and the weight of the accumulated experience embedded in the institutions that surround you. The banking system is old. It is not going away. And understanding it, even approximately, puts you in a better position to engage with it honestly, to evaluate arguments about it clearly, and to navigate the world it makes possible with somewhat more awareness of the conditions that make that world work and the fragilities that put it at risk. That is, perhaps, enough. And here, in the quiet of the night, the history settles and the system continues, as it always has. There is one more dimension of the history worth tracing before we arrive at the synthesis, and it concerns a thread we have touched on but not fully developed: the relationship between banking and the broader patterns of economic development, the way that access to credit has shaped which societies industrialized when, which ideas found funding and which did not, and which populations were able to participate in the economic growth that banking enabled. The connection between financial development and economic growth is one of the most studied relationships in economic history, and while economists debate its precise character, the broad outlines are clear. The societies that developed sophisticated banking systems earliest, the Italian city-states, the Dutch Republic, England, and subsequently the United States, were also the societies that led the major waves of economic expansion in the centuries following. This is not coincidence. Credit enables investment that would otherwise be impossible, and investment in new production methods, new technologies, and new organizational forms is the mechanism of economic growth. The textile mills of the English Industrial Revolution, the railroads that transformed the American continent, the steel and chemical industries of the German economic miracle, all required the prior development of banking institutions capable of mobilizing the capital they needed. This connection between banking and development has been one of the central concerns of development economics, and it has generated a substantial literature attempting to identify the institutional conditions under which banking systems contribute most effectively to economic growth. The broad finding of this literature is that banking systems that are well regulated, that direct credit toward productive investment rather than speculation, that maintain adequate capital against losses, and that serve a broad population rather than a narrow elite, tend to produce better development outcomes than those that do not. This is not a profound insight in the abstract, but translating it into specific institutional recommendations for specific countries at specific stages of development has proved genuinely difficult, and the track record of advice in this area is mixed. The history of banking in the developing world, and particularly in the countries that were under European colonial administration for much of the 19th and 20th centuries, adds a darker dimension to the story. The banking systems that European powers established in their colonies were typically designed to serve the needs of colonial trade and the expatriate commercial community, rather than the development needs of the indigenous population. They channeled resources out of the colonies toward metropolitan investors, provided credit on terms that the local population could not access, and sometimes actively undermined the informal credit networks that had previously served local communities. The financial underdevelopment of much of Africa, Asia, and Latin America in the post-colonial period reflected in part the legacy of colonial banking systems that were never designed to support the broad-based development of the economies they served. The post-war development finance institutions, the World Bank, the International Monetary Fund, and the regional development banks were created partly to address this legacy, providing credit and technical assistance to countries whose banking systems were too underdeveloped to finance the investment needed for economic growth. Their track record is contested, and the conditions they have attached to their lending have been criticized on both political and economic grounds. But the underlying insight that motivated their creation, that the provision of development finance to countries that could not access private capital markets was a legitimate and important public function. reflects an understanding of the relationship between banking and development that the history of the preceding 2 centuries had made difficult to ignore. The microfinance movement, which emerged in the 1970s and 1980s as an attempt to extend access to credit to the very poor in developing countries, is a more recent chapter in the same story. The Grameen Bank in Bangladesh, founded by Muhammad Yunus, was the most prominent early example, lending small amounts to groups of women who guaranteed each other's loans, using social pressure and mutual accountability to substitute for the collateral that conventional banking required. The microfinance model spread rapidly and attracted enormous enthusiasm, both because it seemed to offer a way of reaching populations that conventional banking could not serve, and because the repayment rates achieved by early microfinance institutions were far higher than conventional wisdom had predicted. The movement also attracted critics who questioned whether the interest rates charged were compatible with the poverty reduction objectives of the programs, and whether the evidence for the development impact of microfinance was as strong as its proponents claimed. The debate over microfinance is ongoing, and the honest assessment of the evidence suggests that it is neither the panacea its most enthusiastic advocates claimed, nor the predatory scheme its harshest critics alleged, but something more complex and context-dependent than either characterization allows. What the microfinance story illustrates, alongside the broader history of banking in developing countries, is the same tension that runs through the entire history of banking, between the genuine economic value that credit provides and the very real potential for the credit relationship to become exploitative when there are significant power imbalances between lender and borrower. The money lenders who charged ruinous rates to desperate peasants in 19th century India, the predatory lenders who pushed high-cost mortgages onto vulnerable borrowers in the American subprime market of the early 2000s. And the microfinance institutions that charged interest rates that consumed a disproportionate fraction of the income of their poorest borrowers are all instances of the same basic dynamic. Credit provided in circumstances where the borrower has little bargaining power and the lender has significant leverage to extract returns that the borrower would not voluntarily accept if they had alternatives. Addressing this dynamic is one of the oldest challenges in banking policy, and it has never been fully solved. This is where things get really interesting from a historical perspective, because the recurring debates about credit and exploitation that appear throughout banking history reveal something important about the nature of the institution itself. Banking is not a neutral technology. It is a social relationship, embedded in structures of power and inequality that shape who benefits from it and who is harmed. The progressive extension of the benefits of banking to wider populations, from wealthy merchants to the middle class to the working class to the global poor, has been one of the most important developments in the social history of the past 2 centuries. But this extension has never been straightforward, and it has always been accompanied by new forms of the exploitation that motivated the original critique of lending. Understanding this history does not resolve the contemporary debates about financial regulation, consumer protection, or development finance. But it does provide the context within which those debates are taking place, and it suggests that the appropriate response to the tensions in banking is not to idealize either the market or the state, but to maintain the kind of ongoing, empirically grounded engagement with the question of how to make credit serve broad social purposes rather than narrow ones that the history of banking institutions represents at its best. There is a beautiful detail in the etymology of the word credit that is worth noting before we close. The word comes from the Latin credere, to believe or to trust. To extend credit is to believe in someone, to trust that they will honor their obligations, to make a bet on the future based on the assessment of a person or an institution in the present. The entire 4,000-year history of banking is, in the deepest sense, a history of this act of trust, of the social technologies that human beings have developed to make trust between strangers possible at scale, and of the recurring failures of those technologies and the reconstructions that followed those failures. The institutions that surround banking today, the central bank, the deposit insurance system, the capital requirements, the supervisory framework, are all attempts to make the act of trust that banking requires more credible and more reliable. They do not eliminate the possibility of failure. They reduce the frequency and severity of failures in ways that have, on balance and over the long run, made it possible for the banking system to perform the functions that the modern economy depends on. And the ongoing debates about how those institutions should be structured and what objectives they should serve are debates about how to do this more effectively, more equitably, and more durably. In a world where the dynamics of credit creation continue to produce the same cycles of expansion and crisis that they have produced for 4,000 years, you understand now, resting here, something of that depth. The bank is not a modern invention. It is a very old one, older than most of the political institutions that govern it, older than most of the languages in which its operations are recorded, older than most of the religions that have tried at various points in history to regulate or prohibit it. It has survived every civilization that has tried to suppress it and every crisis that has threatened to collapse it. It will be here tomorrow and next year and in the years after that, performing the same essential function it has always performed, connecting the savings of the cautious with the ambitions of the productive, and creating, in the process, the money that makes the modern world run. You are lying there now, and the system continues. The promises hold, as they mostly have, across 4,000 years of human economic life. And here, in the quiet, that is enough. But we will come back to that, because before we arrive at the synthesis, there is one more period of banking history worth examining in some detail, one that brings us closest to the present, and that helps explain why the banking system you live inside looks the way it does. This is the period from the financial deregulation of the 1980s through the global financial crisis of 2008, a period of approximately 30 years in which the constraints that had stabilized the banking system for the preceding 4 decades were progressively dismantled, with consequences that were, in retrospect, predictable to anyone who had paid careful attention to the earlier history. The deregulation of banking in the 1980s was driven by a combination of economic theory, political ideology, and the practical pressures created by financial innovation that was moving activity outside the regulated banking sector. The economic theory was largely supplied by the efficient markets hypothesis and its associated framework, which suggested that financial markets were good at allocating capital and that regulatory constraints on their operation reduced efficiency without corresponding gains in stability. The political ideology was the broader market-oriented reform movement that dominated economic policy in the United States and Britain through the 1980s, which was skeptical of regulation in general and of financial regulation in particular. And the practical pressure was created by the emergence of money market funds, commercial paper markets, and other financial instruments that offered bank-like services without the regulatory constraints applied to banks, attracting business away from the regulated sector and creating competitive pressure for deregulation. The result, across the 1980s and 1990s, was a progressive dismantling of the regulatory framework that had been built in response to the Depression. The Glass-Steagall Act, which had separated commercial banking from investment banking in the United States since 1933, was effectively eviscerated through a series of regulatory rulings and ultimately repealed in 1999. The limits on interest rates that banks could pay on deposits, which had constrained competition for funding and limited the pressure to take risks in search of yield, were eliminated. Capital requirements, while formally maintained and technically enhanced through the Basel Accords, were effectively weakened by the expansion of off-balance sheet activities and the increasing reliance on internal risk models that consistently underestimated the systemic risks of the financial innovations. the banks were adopting. This is where everything shifts in the story of late 20th century banking, because what emerged from this period of deregulation and innovation was not a more efficient allocation of capital in a freer market. It was a financial system of extraordinary complexity and interconnection, whose risks were poorly understood by the institutions that bore them and entirely opaque to the regulators who were supposed to monitor them. The mortgage-backed securities, collateralized debt obligations, and credit default swaps that were at the center of the 2008 crisis were not inherently bad ideas. They were applications of genuine financial insights, tools for diversifying and redistributing risk that had legitimate uses. What made them dangerous was the combination of the scale at which they were deployed, the incentive structures that encouraged their creation without adequate attention to their quality, and the regulatory framework that had been stripped of the tools needed to monitor and constrain the systemic risks they were creating. The global financial crisis of 2008 was, in the terms of the banking history we have been tracing, the most dramatic illustration since the Great Depression of the credit cycle dynamics that are built into the structure of private banking, the expansion of mortgage credit through the early 2000s, fueled by financial innovation, regulatory gaps, and the global flow of savings looking for yield in a low interest rate environment, produced the credit boom that planted the seeds of the crisis. When the boom turned in 2006 and 2007, as house prices began to fall and the quality of mortgage credit became apparent, the reversal was rapid and severe. The financial institutions that had been most aggressively expanding their balance sheets during the boom found themselves most exposed to the contraction, and the interconnections between institutions, built up through the web of derivative contracts and short-term funding relationships that the boom had created, transmitted distress across the system with a speed and thoroughness that surprised even the most pessimistic observers. What the crisis of 2008 added to the history of banking was a particularly clear demonstration of what economists call systemic risk, the risk that the failure of one institution or one part of the financial system will trigger the failure of others through the direct and indirect connections between them. Individual banking crises had produced systemic consequences before, as the Florentine collapses of the 1340s had shown. But the global financial system of 2008 was so much more interconnected, and the instruments connecting its constituent parts so much more complex and opaque, that the systemic consequences of the initial failures in the American mortgage market were far more extensive than anyone had anticipated. Banks in Iceland, Germany, and the United Kingdom held losses on American mortgage securities. The interbank lending market froze as banks became uncertain about the solvency of their counterparties. The money market funds that had become the de facto short-term funding market for much of the financial system experienced runs, and the credit contraction that followed the crisis transmitted its effects into the real economy with a speed and breadth that turned a financial crisis into the deepest global recession since the 1930s. The regulatory response to 2008, embodied primarily in the Basel III Accords and the Dodd-Frank Act in the United States, represented the most comprehensive restructuring of banking regulation since the post-Depression reforms of the 1930s. Capital requirements were significantly increased, with new buffers designed to ensure that banks could absorb losses without requiring government support. Liquidity requirements were introduced, mandating that banks hold buffers of liquid assets sufficient to survive periods of market stress. Systemic risk was explicitly recognized as a regulatory concern, with new frameworks for identifying and supervising systemically important financial institutions and for managing the failure of such institutions without triggering wider systemic consequences. And the shadow banking system received more regulatory attention, though the challenge of regulating activities that are specifically designed to be outside the regulatory perimeter remains one of the most difficult ongoing problems in banking regulation. The resulting banking system is, in the assessment of most informed observers, more resilient than the one that entered the 2008 crisis. The major banks hold more capital, maintain larger liquidity buffers, and are less dependent on the short-term wholesale funding that made them so vulnerable in 2008. But it would be historically naive to conclude that the reforms of the post-crisis period have solved the fundamental problems of banking. As opposed to addressing the specific vulnerabilities that the 2008 crisis revealed, the history of banking is, in part, a history of regulators fighting the last war while the financial system innovates its way into new configurations of risk that the existing regulatory framework has not yet addressed. The next crisis, whenever it comes, will almost certainly have features that the post-2008 reforms did not anticipate. This is not a counsel of despair. The institutional memory embedded in the post-crisis regulatory framework is real, and it makes the financial system more robust in the ways it has been tested before. But maintaining appropriate humility about what the current regulatory framework does and does not protect against is itself a lesson of 4,000 years of banking history. One of the most consistent findings across every period and every context. The confidence that we have finally got the regulatory framework right has been expressed before. It has not previously survived the next crisis intact. There is one final thread worth pulling on before we let this rest, and it concerns what might be called the future of banking. The ways in which technology and innovation are transforming the institutional landscape in ways that may, in the coming decades, be as significant as the innovations of the medieval Italian bankers or the establishment of the first central banks. The digital transformation of banking, which began with the computerization of back-office processes in the 1960s and 1970s, and is now producing mobile-first digital banks and algorithmic credit scoring and blockchain-based payment systems, is changing both who can provide banking services and how they can be provided. The entry of technology companies into financial services, the emergence of peer-to-peer lending platforms that match borrowers and lenders without a bank intermediary, and the development of central bank digital currencies that would allow individuals to hold accounts directly at the central bank rather than at commercial banks, all represent potential changes to the institutional structure of banking that the history we have traced has not yet encompassed. Whether these innovations will ultimately change the fundamental dynamics of banking, the credit creation function, the maturity transformation, the pro-cyclical tendencies of the credit cycle, is genuinely uncertain. The history of financial innovation suggests caution about claims that new technology has eliminated old risks. The Bill of Exchange was a financial innovation of enormous practical importance, but it did not eliminate the risk of sovereign default or the credit cycle dynamics that produced the Florentine collapses. The securitization of mortgages was a financial innovation of genuine theoretical merit, but it did not eliminate the credit cycle dynamics that produced the subprime crisis. What technology changes in each generation is the specific instruments and the specific institutions, not the underlying dynamics of credit creation and its consequences. But technology also changes the distribution of benefits and risks from the banking system, and the innovations currently underway may well change that distribution in ways that are either better or worse, or more likely both better in some respects and worse in others than the current arrangement. You are lying there now, at the end of a very long journey through 4,000 years of history, from the clay tablets of Babylon to the servers of the digital bank, from the bench of the medieval money changer to the algorithm of the automated credit decision. The instruments have changed, the scale has grown, the speed is increased by orders of magnitude, but the promise is the same. Your money is safe here, and we will return it when you ask. And the tension is the same. That promise depends on confidence that is itself dependent on the system continuing to function, and the system's functioning depends on the collective willingness to maintain the trust that makes it possible. Banking is old, It will be here tomorrow, and understanding it, even approximately, puts you in a position to engage with it more honestly than most people do. That is perhaps a reasonable thing to carry into sleep. There is something the orientation paragraph of this conversation wants to be clear about before we move toward the quiet end of the night. What we have done tonight is give you the shape of a history that most people who use banks every day have never encountered. Not a comprehensive academic history, because 4,000 years cannot be compressed into a single evening without significant simplification, but an honest account of the main dynamics, the main patterns, the main lessons that the 4,000 years have accumulated. The most important of those lessons is probably the one that is easiest to forget during a long period of stability, that the banking system is a human creation, built by people solving the problems directly in front of them with the tools they happen to have, and that it reflects human ingenuity and human limitation in roughly equal measure. The bill of exchange was a brilliant solution to the problem of moving value across the continent without moving metal. It was also, when it was abused, a mechanism for creating claims that could not be honored. The central bank was a brilliant solution to the problem of providing emergency liquidity in a crisis. It was also, when it was captured by political interests or when its interventions were too aggressive, a mechanism for producing inflation. The deposit insurance system was a brilliant solution to the problem of bank runs. It was also a mechanism that reduced depositors' incentives to monitor the risk-taking of their banks. Every solution in banking history has had this character, genuinely useful for the problem it addressed and generative of new problems that it did not address or that it actively created. This is not a reason for nihilism about the possibilities of institutional design in banking. It is a reason for the kind of ongoing, adaptive engagement with the question that the history represents at its best, the recognition that the work of making banking serve broad human purposes rather than narrow ones is never finished and never fully successful, but that the accumulated institutional knowledge of the people who have been trying to do this work for the past 4,000 years is genuinely valuable and worth building on. The history also teaches something quieter and more personal. Every time you use a bank, you are participating in an institution that is, in its essentials, the same institution that the merchants of ancient Mesopotamia were using 4,000 years ago. You are trusting a stranger, mediated by a set of legal and institutional arrangements, with a promise to return what you have given when you ask for it. Most of the time, that promise is honored. And the reason it is honored most of the time is not that banks are inherently trustworthy or that the people who run them are inherently honest, but that the institutional framework surrounding them has evolved over centuries of crisis and reconstruction into something that makes the honoring of the promise more likely than its breach. That framework is fragile. It has broken before. It will break again, in ways and at times we cannot predict, but it has also, on balance, made possible the kind of economic activity that has produced the material conditions of the world you live in, and it has done so across a longer period and on a larger scale than any alternative system of economic organization has yet achieved. You can be critical of it, and there are many things about it that deserve criticism, but you can also be honest about what it has accomplished and what it costs, and why the alternatives, however appealing in the abstract, have consistently proved more difficult to implement than their proponents have hoped. There is one more layer of the history worth examining before we arrive at what all of this actually means for us, and it concerns the origins of banking in the ancient world more carefully than we have so far, because those origins reveal something about the nature of the institution that the later history can obscure. The clay tablets of ancient Mesopotamia that record the earliest known banking transactions are not merely historical curiosities. They are the earliest written evidence of a set of social and institutional arrangements that were already, at the time they were recorded, the product of long prior development. The recording of loans and deposits in writing, using a standardized script on a durable medium, implies the existence of a class of trained scribes, a standard unit of measurement and value, a system of property rights that made debt obligations enforceable, and a level of trade and economic complexity sufficient to make the credit relationships the tablets recorded economically useful. None of these prerequisites for banking emerged overnight, and the banking institutions of ancient Mesopotamia were themselves the culmination of a process of institutional development that we can only partly trace. What the Babylonian tablets reveal, when read carefully, is that the basic structure of the credit relationship, including the specification of the principal amount, the interest rate, the term of the loan, the collateral pledged, and the witnesses to the agreement, was already highly developed by 2000 BCE. The Code of Hammurabi's provisions regulating commercial lending are not the introduction of a new institution, but the regulation of one already well established and generating enough disputes and abuses to require legal intervention. Banking, or something very much like it, is at least as old as written law. It may be older still. This antiquity matters for how we think about banking's place in human economic life. Banking is not an invention of capitalism or of the modern period or of any particular cultural tradition. It is a feature of any sufficiently complex economy, one that emerges from the basic economic logic of matching those who have surplus resources with those who can use them productively, and of managing the risks that this matching involves. The specific institutional forms that banking takes vary enormously across time and place, shaped by the legal traditions, cultural attitudes toward debt, religious prohibitions and accommodations, and the political structures of the societies in which they develop. But the underlying function appears with remarkable consistency wherever economic complexity reaches the threshold at which the credit relationship becomes useful. This perspective suggests that the future of banking, whatever form it takes, will be shaped by the same underlying logic that has shaped its past: the need to match surplus and deficit, to manage the maturity transformation, and to maintain the trust that makes the system function. The specific instruments may change beyond recognition. The institutional forms may evolve in ways we cannot anticipate, but the underlying function will remain because it addresses a need that is as basic as the need for money itself. And banking in some form will be with us as long as economies are complex enough to require it. The question that the history poses for us, and that we are still in the process of answering, is not whether banking will exist, but how it will be structured, who will benefit from it, and what safeguards will surround it to limit the damage that its inherent fragility can cause. These questions have been debated for 4,000 years, and the debate is not over. The most we can say is that the accumulated experience of the history provides some guidance about what works and what does not, and that ignoring that experience, as each generation that believes it has finally solved the problems of banking tends to do, reliably produces consequences that the experience would have predicted. What you carry now into the quiet of the night is a sense of that depth and that pattern. The banking system is old and consequential and imperfect and enduring. Understanding it in those terms, rather than in the simpler terms that everyday life encourages, puts you in a better position to engage with the debates about it that will continue as long as the institution does. And here, resting in the dark, that is enough. There is a particular quality to the history of banking that distinguishes it from most other institutional histories, and it is worth naming before we close. Most institutions in human history have been relatively local in their reach, embedded in specific legal traditions, cultural contexts, and political arrangements that limit their transferability across time and place. Banking is different. The core of what banking does, accepting deposits and making loans, and managing the maturity transformation has been replicated across thousands of years and hundreds of societies by institutions that had no knowledge of each other and no shared cultural or legal tradition. The Mesopotamian temple treasurers and the Italian merchant bankers and the English goldsmiths and the American frontier banks were all, in their essential functions, doing the same thing. They discovered the same institution independently, because the same economic logic that produced it in Babylon produced it in Florence and in London and in New York. This convergent reinvention is itself significant. It suggests that banking is not an arbitrary institutional arrangement that one particular culture happened to develop and export to others. It is a natural feature of complex economies, one that emerges from the basic logic of surplus and deficit, saving and investment, the need to move value across time and space in ways that reduce the friction of economic life. Understanding it as such, as a feature of economic complexity rather than an invention of any particular tradition, changes how we evaluate proposals to restructure or replace it. The fundamental functions that banking performs are likely to persist in any sufficiently complex economy because they address needs that are built into the logic of economic organization at scale. What varies, and what the history shows, can be significantly improved through institutional design and regulatory development, is how well those functions are performed and how broadly their benefits are distributed. The banking system of 2000 BCE Babylon served a narrow commercial elite in a society of enormous inequality. The banking system of 14th century Florence served a somewhat broader merchant class, but remained inaccessible to most of the population. The banking system of the 20th century, for all its failures and inequities, provided basic financial services to a larger fraction of the human population than any preceding system had, and the ongoing extension of financial access in the 21st century, through digital technology and new institutional forms, continues that trajectory. This progress is real, and it counts in the assessment of the system, even while the work of extending and improving it remains incomplete. You are lying there now. The world is quiet, and the banking system is running quietly, as it has run for 4,000 years. The promises are holding, as they mostly hold, and here, in the dark, there is nothing left to decide tonight. It is enough to understand the shape of the thing and to rest. The history is long and the institution is old, and the work of understanding it is never quite finished. But tonight, it is finished enough. The dark is enough, and the quiet is enough. You are lying there now. The world is quiet, and the banking system is running quietly, as it has run for 4,000 years. The promises are holding, as they mostly hold. And here, in the dark, there is nothing left to decide tonight. It is enough to understand the shape of the thing and to rest.